niche alternative investments are really compelling, and because generally they're uncorrelated to other things, unfortunately they take usually a lot more due diligence. However, they can provide in ongoing very attractive returns.
This is the third time I've spoken at the family office. Thank you, Richard Wilson. I spoke here last year, Miami, and now I want to put a shout out to Richard for having us all together. And one of the things that impresses me is he has, it's one thing for us to do well financially, but if you don't have your health, it doesn't mean anything. And he emphasizes that. And then third thing, thank you, Richard, for bringing, he always has a philanthropist. I got taught at a very early age that once you were able to do well for your family, it was my obligation to help others. So anyway, grew up, this is my home turf. I went to El Rodeo, Beverly Hills High, UCLA, and USC. I had a single mom raising me. I'm self-made. My last name is my mother's maiden name. I'm self-made. I work for a firm called Raymond James. We became the fourth largest firm as far as wealth management. We're $1.5 trillion. We just surpassed UBS. One of my partners is here, Golub. You want to stand up and wave? Anyone want to give a card or anything to Golub or me? Go through Golub. Anyway, Raymond James is just we can do anything and everything for you. We take companies public, we raise money. I've been doing this for quite a few years. I started with my bar mitzvah money many years ago. And when I turned 18, my second car was a Jaguar XKE convertible. If $6,000 out the door then, 1967, if I kept it in mint condition, I did not. It'd be worth $300,000 to $400,000 today. But anyway, every young guy who makes money. Anyway, I can go on and on. I've been so blessed. I've been so blessed. The stock market's been good to me. I have a great team. The other thing, anyone who wants to do business, you can fly to Las Vegas because I live there. My office is here, so you can write it off. Ask your CPA, come visit your financial advisor in Beverly Hills or Las Vegas. Anyway.
Thank you, Ron. So you brought up a great point there. When you're investing in things that you want to have personally, you don't ask your CPA, can I write that off? You ask them how we write that off. So then we purchase it the right way. So I'm going to start back down there with you, Ron. What are two strategies you're using capital and your energy? What are you focused on right now?
I'm old school. I have a team that one of my partners who's not with us today, he handles what most brokers do today. They ask the same 50 questions, but I'm old school. I buy individual names. I call companies, for example, I said my middle name is Income. It's really Craig. So, so to give you an idea, I started buying UPS recently. They decided to get rid of one of their biggest customers, a little company called Amazon. They told Amazon in a year and a half, we're going to cut you back in half. They pay a 5% dividend. Stock dropped 20 points. If Amazon had gotten rid of them, it would have been one thing, but they're telling Amazon, we want to go to more profitable business. So that's just one little idea, but I buy business development companies. I buy REITs. They're all publicly traded. The elevator speech should be, what do I do? I make rich people richer. So.
Thank you. Alan, what are areas you're allocating capital and your energy towards these days?
Well, two things. I'll tell you one that worries me and then one that I like. I think niche alternative investments are really compelling, and because generally they're uncorrelated to other things, Unfortunately, they take usually a lot more due diligence. However, they can provide in ongoing, very attractive returns. One area that I worry about, having gotten my fanny shot off years ago, I spent 7 years restructuring California's largest insurance company with a $20 billion debt portfolio. Ouch. There's been this giant sucking sound of money going into specialty finance. I'd caution everybody to be really careful, because the underwriting usually lasts for about 3 years and then problems emerge. So I think you have to be very, very careful.
Thank you. Mark, where are you focused on today in allocating your capital?
Two different things, actually. I'm very involved in philanthropy. It's a core value of mine, and I've been spending a lot of time recently on various philanthropic things, especially with the fires and different things. And then with the business, we've been buying student housing, risk-adjusted returns, where we can add value through operations and capital improvements. And most recently, we purchased a value-add apartment building. It was on an off-market deal from a person that owned it 30 years in Upland, and they had low rents, and it was positioned to add a lot of value by upgrading the units, raising the rents eventually, and then selling it. So that's the latest investment we did. And we're always out in the market looking for the needles in the haystack. And we invest with other family offices in our deals, in high net worth individuals. And I'm the majority of the capital. And we're always hunting, but it's been challenging with high interest rates. But I think it's going to shake out soon.
Aria, what is your focus these days?
It's a very dynamic question. As we sit today, we have geopolitical issues. We have tariffs that just started. Nobody knows what the impact will look like. To be frank, it's a very tough question to answer. I live in Orange County, Newport, and on my way here, I had an hour-long conversation with another individual that runs a family office, and it was like an hour-long economic dialogue. And at the end of the day, a lot of people in the institutional space look at yield, like what is my market cap rate, what is my in place, am I positive leverage? Sure, that's all important. But if we're in a recession, yields come down, or treasury yields. But in my opinion, cap rate on the real estate side, so we're real estate focused, right? So, but cap rate expectations should go up, right? It's a cap rate's risk premium over risk-free yield, which is a treasury. And if we're in a recession, on top of that, rents should come down. So we're basis-conscious buyers, and it starts with location. And I think a lot of people, what caused the GFC and what caused kind of the current issues in the economic backdrop on the real estate side was leverage, but also people chasing yield in Sunbelt markets and tertiary markets. So being local in Southern California, having an all asset class background on the institutional side, before kind of forming my own investment firm, which through a father's business sale, it was a distributor, we became a family office. We're very basis conscious, trying to buy industrial in Southern California. However, with immigration issues, deportations, tariffs, industrial amongst other asset classes could get hurt. So if we're buying deals like our recent one in Irvine, we feel good. But nobody wants to catch a falling knife, but what you know is location, basis, buying below replacement cost, and having either an all-cash purchase or low leverage where you don't have to feel like you have to sell a deal during a certain time frame. Because what if in 3 to 5 years, we're in this economic doldrum and you can't refinance out your debt or your asset's not liquid? So it's a very dynamic question. I think if anyone knows what's going to happen, and then this is like their theory, they might be in the wrong, because the current data that is reflected in what we have today is not reflective of what Trump just did yesterday, enacting 25% tariffs on 3 important import-export economies. So that's my take.
Thank you for that. Jim, where are you focused with your allocations today?
Sure. First thing is I try to have an incredible deal flow network of early stage breakthroughs, because it's good to spread your bets around different industries. If you can get in with somebody super famous, super respected, Nobel laureates or top venture funds. Two areas. One is a very unusual friend of mine working with a company called olfactive.bio that's looking at how to replace Ozempic type drugs with certain foods that you eat. So food as medicine is an interesting little area. Another area I'm kind of wild by, there's a great documentary that came out 7 months ago called Wild Wild Space, kind of a takeoff on Wild Wild West. And it's about the amazing things we're using every day that are all based on satellite information, and how two companies, Planet Labs and Rocket Labs, have become $4 billion publicly traded companies. There's a lot going on in niches in satellite, sort of like when it was hardware.com 20 years ago, and then it was hammer.com, and then it was nail.com. So the satellite space in the startup world, I'm working with a couple of those. So those are a couple of examples.
Thank you. Avni, where are you allocating at this time in the market?
Well, we represent a whole group of family offices, and the specific types that we represent are usually less on the market side. A lot of them are generational business owners where the kids got involved, set their own mandates. So we represent a very specific type, like a first, second generation usually. And these guys are very real estate heavy. So I can't stop investing in real estate. But within real estate, we are looking at infrastructure, data centers. We're also looking at conversions for assisted living. We're also definitely always looking at good multifamily deals over 100 units. These are just the basics. We also have very niche investors in the hotel industry, which is global. And so we're always looking for good deals in real estate. Obviously, everybody is. But something that's new is obviously technology. We're pretty heavy on AI, anything that has an AI component. ESG is huge right now. We're definitely always investing in good climate clean tech, and not greenwashing, quote unquote, but really, really looking at what's the net carbon emission at the very ground level. Very interesting to us as well. And what's very exciting space for us is entertainment and tech. So that's one of the new companies. It's all holograms. And so what you see in the Sphere in Las Vegas, it's very exciting space to be in. So we're seeing a lot of energy there.
Thank you. Since we're down to about 10 minutes and I have a handful more questions, I was going to check to see if we had any from the audience first before we go back down the panel again. Is any questions out of the audience?
For those of you that mentioned real estate, are you referencing value add or development?
Do you want me to start? Are both for us value add, because we represent a different variety. Both are very impressive for us, especially if it's in the assisted living space. Value add is very important, and if it has tech added to it, perfect.
Arya, do you want to go ahead and answer that too? And then we'll go to Mark beside you.
Yeah, existing. I don't think development pencils. I mean, I think some people on the other side of the spectrum, on what I believe in, think, oh, we're in this on multifamily side or industrial side, supply is tapering. So usually it's like a 24-month cycle for apartments, 15-month cycle for industrial. So some people are like, let me break ground today, and in 12 to 24 months, it'll be a good time to deliver. But, being basis conscious, we always want to buy below replacement costs, which means we don't want to develop. So we buy existing. So that's, yeah.
I'm a recovering developer, so I used to do it. So we've actually bought some things from developers where they weren't doing as well, where we could get a great basis and have this brand new building. And so that's some of the stuff that we looked at. We're all about value add. And a lot of times value add can be from the repositioning of the management. There's a lot of economies of scale. There's a lot. I mean, one of the great advantages that we've had in buying properties is buying somebody else's not so great operations. And then if you're strategic about your capital improvements, you really know the market and you know what you can do to get what rent. We do a lot of that, both student housing and in multifamily.
Thank you. So we'll start down on the end. My last question for the panelists is, what's coming? What's next? What new trend are you thinking about? What are you watching for? And any comments you want to share?
Thank you for an open end. The one comment with Raymond James, we own the bank. I came from the Stagecoach. The Wells Fargo owned the wealth management. We own the bank. Big difference. So for all of you out there, we lend. We'll take you public. But you have to be a client. We don't have the brick and mortar. But as I said, we're the fourth biggest firm as far as wealth management. So if you come to us, be a client, and then we'll go to work for you. Anyway.
Thank you. Alan?
A couple of things. One of the things we do out of the family office at Shinnecock Partners is we are, and I know you have another panel on it later today, we have over $100 million lent against fine art. Think Picasso's, Jeff Koons, people like that. It's been a very interesting business. That's something worth considering. Be careful, it takes endless due diligence. Another thing that I think is a trend, you have Reg D offerings, particularly used in real estate. I'm a little skeptical about it. I don't have time to go into it totally. Then there's Reg CF crowdfunding. Be careful there. The loads of crowdfunding, the costs involved are very high. Now, I think there are better solutions to Reg D. Clearly, I'm prejudiced. In AsureX, we figured out a way to give control to the investors. How many times has anybody in this room invested in a Reg D offering? And the manager says, Alan, you're too dumb to know when to sell it, so we're going to charge you 1.5% per year until we decide to sell it. And shockingly, there's an extension risk there. I think you have to give investors the control of the underlying asset. And I think there's some very innovative ways to do that. We're pursuing those through AsureX.
So with interest rates being high, we think there's be dislocation in the market. There's a lot of people that got variable rate loans, and those are going to go to, they're going to sell, and probably for undervalue. And then also, like I said, the new product that where a developer, merchant builder needs to get rid of it, and through better management and a strategic buy, you could make a lot of money.
Yeah, I think that's happening a lot out there. There's some folks that are upside down on their variable rate debt. I just seen a deal come across my desk. These folks bought it 2 years ago for almost $40 million, and they're buying it for 30, and the actual debt on it was 29. So they're buying it for $1 million over what the actual debt is. So we're starting to see that out there in the market. Go ahead.
It hasn't happened yet.
Yeah.
People keep on waiting. When is it going to happen? When's it going to happen? It'll happen soon.
Yeah, it's all supply.
TBD.
I carry off of what they just indicated. That story of buying below the debt value hasn't occurred yet. And in real estate, it's all supply demand, not only on existing supply, but also available deals on the market. And we haven't really seen that storm. And what's happened the last month in the economy, on top of the higher rate environment, even if we get into lower yields, because if we're in a recession, treasury yields drop, cap rate expectations go up like I just indicated, we haven't seen that storm. So imagine we have this storm on top of like people's wariness. And if rents drop across apartments or industrial sector, student housing, I think by September of this year through 2026, we're going to start seeing a lot of deal flow on the real estate side.
Thank you. Mark, what are you thinking the new investment trends? I know you were talking about some space stuff just a few minutes ago. Are you looking at anything else other than just space?
Yeah, the area I think we're seeing heat up, and as the AI boom quiets down a little, in my opinion, over the next year and a half, the area of electric vertical takeoff and landing, eVTOLs, which there's two segments in there people don't understand. They kind of lump them all together. One are called air taxis. And two companies worth $3 billion each are Joby and Archer that are going to be picking you up. They've already been doing demonstration flights in New York City and California. They're going to pick you up at an airport, drop you downtown in 10 minutes for $80. So the electric vertical takeoff is going to change things. I'm an early investor 4.5 years ago in a personal flying car company that was featured on national NBC News 5 days ago called Aleph Aeronautics, where you're going to put it in your garage, you're going to buy it at retail at a profit for $35,000. This is when it's in volume manufacturing 9 years from now. The first ones are going to cost $300,000, and they've got 3,300 orders for $1 billion worth of sales. But flying cars and eVTOLs, air taxis, and then the precursor to all of that are the drone deliveries that you're seeing Amazon and Zipline drones starting to do hundreds of millions of drone deliveries of a little bit of medicine or a pizza or a salad to your front lawn. You're going to see that coming up quicker than you'd realize, maybe in the next 6 months.
Thank you. Just before the Miami show, I was at a car show downtown Miami, just off of Lincoln, and there was a single passenger droney looking helicopter thing that they had on display there. But I think you get in and I'm not sure if you actually fly it or if somebody actually delivers you someplace where it's going to land. So
FAA they want a pilot in there right now. So it will be autonomous, but right now it has to be piloted. And two leaders in the personal space, but they're not cars, are Pivotal, funded by Larry Page, and Jetson One, a nice play on words there for George Jetson, yep. Swedish company, but they keep saying, oh, we're going to deliver in 3 months. So the ultralight eVTOLs are about to be delivered in the next couple of months.
All right, and last but not least, Avi, if you could say where you're heading with your investments these days?
Yeah, actually, the most exciting part of it, I think, is definitely drones. We are looking at those as well, especially when it comes to the play with DoD. We're also looking at humanoids. And I think it was very interesting to talk about the hologram that we were talking about in the entertainment tech space. Those are like the exciting, of course, high risk. And of course, real estate doesn't die off for us. We're very focused on assisted living and senior facilities. So that's the long-term play. Thank you.
So interesting thing this year for New Year's Eve at our country club where we were, there was an actual 500 drone New Year's ring-in show. And I think the drones and with the colors and the way they can control those from one spot may actually take over for fireworks down the road.
Yeah, really cool.
Join the Family Office Club by visiting familyoffices.com. We look forward to seeing you at our next live event.